Hello again, everyone. This is Professor Michael Fournet, and this is Introduction to Principles of Microeconomics. This is the fifth week in the course, and for this week we are going to undertake the challenge of starting to study what are called market structures, or markets. And for this week, for week 5, we're going to take a look at the market structure called pure competition. Pure competition serves as kind of our standard market structure in the sense that we compare all activities in other industries to the purely competitive model. So the purely competitive model represents the ideal market activity from an economic standpoint. In this chapter, I am going to cover a lot of topics, and I'm also going to try and reorganize the way Chapter 9 is presented. There are a lot of details in the market structure chapters 9, 10, 11, because by their very nature, studying markets involves looking at a lot of details. And so what I'm going to attempt to do is I'm going to attempt to organize the material in this lecture so that it has a sense of flow. It has a flow to it. Because some of the topics as presented in the chapters are not organized on a flow basis. There's a lot of information, and sometimes it's easy to get kind of lost in terms of where the author is trying to go with the information. So I'm going to take the information in chapters 9, 10, and 11 and try to organize it in a framework that gives the material a sense of flow. So what I'll need from you is I'll need your reactions to this approach. So if you'll send me comments to say, okay, yeah, this makes it easier to study, or this makes it more difficult, please let me know that so that I can make the necessary adjustments. Alright, so let's begin by taking a look at the details reflected in Chapter 9, which focuses on the market structure called pure competition. And the first thing I want to look at is I want to go back and revisit the issue of accounting versus economic profit. We talked about very briefly about accounting costs versus economic costs at the end of the week 3 lecture. But now I need to go back and revisit the accounting and economic issues because they're going to become essential in the next 3 chapters. So we want to spend some time making a distinction between accounting profit and versus economic profit. Okay. All right. In terms of accounting scenarios, there are 3 that are relatively common. A firm could make an accounting profit, and that is where the revenues it makes, the total revenue, is greater than the total cost, again explicit cost, that it incurs. So when a firm's revenue is greater than its explicit cost, the cost that is incurred, it is said to make an accounting profit. Another way to think of that is think of revenue as an inflow. It's the amount of money that flows into a business. Think of cost as an outflow. And so when the amount of money flows in is greater than the amount flowing out, the business is said to profit. Now accounting loss is just the opposite. It's where the amount of money flowing out, the expenses, the total cost, is greater than the amount of money flowing in, the revenue or the sales. So when total cost is greater than total revenue, a firm is said to make an accounting loss. Accounting break-even occurs where the inflows and the outflows are the same, where the revenue, the amount flowing into the business, is just equal to the total cost, the amount flowing out. And so under those conditions, the firm is said to experience accounting break-even. Economically, there's a lot of similarity, but yet there's also some very subtle differences. We define economic profit as taking total revenue, price times quantity, just like the accountants calculated, and having the case where total revenue is greater than total economic cost. And so if you remember from the end of the the week 3 discussion, total economic cost consists of explicit costs plus implicit costs, where the implicit costs represent opportunity costs. What cost or sacrifice based on the choice made. And so when total revenue exceeds total economic costs, the firm is said to make an economic profit. When a firm experiences economic loss, that's when the total revenue it makes is less than the total economic cost incurred. Economic break-even is where the total revenue that a firm makes is just equal to the total economic cost it incurs, where the economic cost is the sum of the explicit cost plus the implicit cost. Now, having depicted, accounting scenarios versus economic scenarios, they look very similar. But we want to focus our attention primarily on the economic scenarios, because the results we're going to generate in Chapter 9, in Chapter 10, and in Chapter 11 are predicated on the economic scenarios. So the results will be in terms of economic scenarios. So I really need to look closer to see exactly what do I mean by the economic scenarios that I've identified. And so to see that, I've created an exhibit here that shows kind of succinctly what each economic scenario really means. So when we say that a firm is making economic profit, what that means practically is the choice made by the firm was the best choice. So if a firm chose to participate in a certain industry as opposed to participating in an alternative industry, if it turns out that the industry chosen to participate in resulted in higher profits than the alternative, then the firm is said to make economic profit. So economic profit is where the choice made, what the business chose to do, turns out to be better than what it could have done as an alternative. So you made the best choice, and so the best choice we identify as resulting in economic profit. Economic loss, on the other hand, economic loss is where a firm made a choice, and the choice made was not the best choice. So for example, if I were a business and I had the option of participating in industry A, where I could have made $50,000 accounting profit, but I chose to participate in industry B, where I only made $10,000 accounting profit, then my choice was not the best choice. My best choice would have been to participate in industry A, where my profit would have been larger. So you make an economic loss, or a firm experiences economic loss when the choice it made was not the best choice. Okay? Economic break-even, what it really means is the choice made, what the business chose to do, was neither better nor worse than the alternative. So if I, as a business, chose to engage in some activity that resulted in my earning a $10,000 accounting profit, and I could have done something else in a different industry and also made a $10,000 accounting profit, then my choice is neither better nor worse than that alternative. So economic break-even means that the choice made by a business was neither the best choice nor the worst choice. It's important to note, in fact it's critical to note, that it is possible for you to have multiple accounting scenarios and economic scenarios simultaneously. And let me describe what that means, and then I'll try and demonstrate shortly. It is possible that a firm could make an accounting loss, and we could conclude that the firm makes economic profit. That's one combination. So the firm makes accounting profit, but we assume the firm makes economic loss. Okay? Now, if the firm makes an accounting profit, that means its revenues were greater than its explicit cost that it incurred, whatever it chose to do. But if we conclude that the firm makes economic loss, it means that that profit it earned in what it chose to do has to be smaller than the profit it would have earned doing something else. Because remember, economic loss means your choice was not the best choice. You could also have a firm that experiences economic loss, and we can conclude that the firm experiences accounting loss, and we can conclude that the firm is making economic profit. How is that possible? Accounting loss, of course, would be the total revenues would be less than the firm's total cost, so it makes an accounting loss. But for it to make economic profit, the accounting loss it incurs has to be, in this case, smaller than the loss it would have incurred doing something else. So if I chose to do something as a business and I end up losing $20,000, if I had, as an alternative, I had done something else and would have lost $50,000, even though I have an accounting loss, my loss of $20,000 is better than having a loss of $50,000. So I'm actually experiencing an economic profit, even though my balance sheet shows an accounting loss. So you got to be cognizant that you can have these multiple simultaneous, economic scenarios and accounting scenarios, and I'll try to always be conscious of that as we go through examples. And so let's take some numbers and see if we can look further at what it means to have accounting profit versus economic profit. All right, so here's a scenario. Let's say we have an entrepreneur, someone who has some bright ideal, and they want to determine, well, do they set up shop in industry A or do they set up shop in industry B? Okay. Now, let's say that the entrepreneur says, okay, I have a hunch, or maybe I've done some market research that says it's best for me to set up my business activity in industry A. So industry A is the choice. So the business devotes all of its resources to producing output in industry A. As an alternative, the business could have set up shop in industry B, but we'll assume in the first scenario that it didn't choose to do that. And let's say that after 1 year in industry A, the firm experienced revenues of $500,000, and its total expenses, its total explicit cost was $485,000. So at the end of 1 year, when we compare the revenues and the expenses, the firm makes an accounting profit of $15,000. So based on its choice of participating in industry A. Now, unbeknown to the firm, because we can never have perfect knowledge of the future, let's say in industry B, after 1 year, the total revenues there that would have been earned would have been $500,000. The total expenses that would have been incurred would have been $450,000. So if, as an alternative, if the entrepreneur had to set up shop in industry B, would realize an accounting profit of $50,000. Now, the choice was to be in industry A. That was the choice. And by making that choice, this choice proves to be not better than being in industry B. And so we say, even though the firm makes an accounting profit in industry A, the firm is going to realize an economic loss because the choice made, being in industry A, was not better than the alternative. And so to calculate that, we would take, for example, we were calculating the amount of the economic loss. So if industry A is the choice, which we're assuming here, you take the total revenues the firm makes minus its total economic cost. So the revenues that the firm made was the $500,000 in the first year. The total economic cost, which consists of the explicit cost plus the opportunity cost, the explicit cost that incurred was $485,000. So that was the total expenses that actually incurred. The opportunity cost now is going to be what the firm gave up by being in industry A. And what the firm gave up was the accounting profit it would have earned in industry B, which was $50,000. So the $50,000 represents the opportunity cost, what the firm gave up by making the choice to be in industry A. And so when you net it out, it turns out the firm experiences a loss of $35,000. So this $35,000 loss is telling us how much worse its choice was than the alternative. So if it had participated in industry B, it would have made a profit of $50,000. But in lieu of doing that, it participated in industry A and only made an accounting profit of $15,000. So by choosing to participate in industry A, it incurs a loss. It loses $35,000 that it would have made had it participated in industry B. Now, if the entrepreneur had chose to participate in industry B as opposed to industry A, the results would have been just the opposite, and the firm would have made an economic profit, as I've demonstrated here down below. All right, so this shows that a firm can make an accounting profit, but yet also experience economic loss, because economics is looking at how your choice made. The choice you made, how does it compare to the alternative? And you got to keep that in mind, because it's going to be a kind of consistent theme running through these chapters. All right, so as I said at the outset, I'm going to try and reorganize the information and give it a sense of flow. And so I have this framework that we want to try to adhere to when it comes to analyzing market structures or markets. And the first stop in this framework is you have to look at the assumptions for the industry of the market. So at the beginning of each chapter, there are some assumptions or characteristics of each market, and those assumptions and characteristics serve as the rules or boundaries in which you study the market. Like, for example, in pure competition, some of the assumptions are that there are thousands of little firms competing against each other for the right to serve customers. The products they're producing are identical or homogeneous. There are no barriers to entry or exit, so firms can move into the market. Firms can leave at their leisure, so there's no barriers keeping them from coming in or leaving. And also the firms are what we call price takers, meaning that the price the firms charge is not set by the firm, but is set by the market. And so the firms simply take the price established in the overall market and they charge that price. Now, as a result of the firms being price takers, we say they have no market power. And market power is where a firm can alter the price that it's charging. So if a firm has market power, it can raise the price. But these firms, because they have no market power, because they're simply taking the price that's generated by the market, they can't adjust the price, right? So the assumptions kind of lay the framework, lay the foundation for all the other work you do when you study market structures, right? So always look at the assumptions first, because they're going to be your guidelines for studying the market. In the next stop, once you have the assumptions in place, is that's what I call the short run phase. And by definition, when we say short run, that means there's going to be some fixed inputs and some fixed costs identifiable in this phase. So, because remember, fixed inputs and fixed costs only exist in the short run. And so what you do in the short run phase is, first of all, you do some house cleaning stuff, what I call preliminary issues, where you introduce some unique aspects of the market structure that you will need to account for. And I'll demonstrate the preliminary issues in a second. And then once you have the preliminary issues out of the way, then you go through some economic scenarios. Like we just talked about economic profit, we talk about economic loss, we talk about economic break even. There's another economic scenario called the shutdown case. And those four scenarios are how we assess how the firm is doing in the marketplace. For example, if a firm makes economic profit in the short run, it means that being in that industry was the best choice. Okay, so we'll look at these scenarios to see exactly how the firm is faring in this market structure. And you got to keep in mind, under pure competition, there are thousands of little firms, so the competition is very intense. And so these firms are each individual firm is facing some seriously intense competition. All right, so once we finish looking at the scenarios and the preliminary issues of the short run phase, then there's a transitory phase known as that I call the adjustment phase. And you won't find the adjustment phase in the text, not identified as the adjustment phase, but there is some activity that lends itself to being housed under what I call the adjustment phase. So the adjustment phase is just my way of kind of continuing the flow from the short run. So the activities from the short run flow through the adjustment phase, and they ultimately flow and terminate in the long run phase. Now in the adjustment phase, what you look at are what I call entry-exit dynamics. And really, because we're talking competition, we want to see, does competition result in firms coming into the industry? Does it result in firms leaving the industry? And if the firms do come in, how do they cause the overall market to adjust? If firms leave, how does the fact that the firms leave, how does it cause the overall market to adjust? Now, so we'll look at the entry-exit dynamics to see if in fact the inflow and outflow of competition, how it will affect activities in this overall market. And I'll demonstrate to you what happens there. And then once things flow through the adjustment phase, where the adjustment phase is kind of a settling of the market, then we'll kind of tie all the pieces together in the long run phase. Again, when you're in the long run, remember there are no fixed inputs and there are no fixed costs in the long run. So all of the inputs and the costs in the long run are variable. So what we'll do in the long run is we'll say, okay, based on the activities from the short run and the adjustment phase, how does this industry ultimately stabilize? And so we'll have this ending economic scenario we'll look at that will tell us how a firm has fared after having competed in the adjustment phase and the short run phase. And the last thing we'll do in the long run phase is we'll conduct some efficiency tests, and the efficiency tests are to help us to determine if there's any type of waste. All right, so that's the setup. Let's see how it plays out. So our first stop then, now that we have the assumptions in place, the next thing we have to do is we have to look at, in the short run phase, the preliminary issues. So here are the preliminary issues, which is a part of the short run phase. And in the short run phase, we look at the concept of total revenue. Total revenue, of course, is the price times the quantity, which we have dealt with previously. But there are a couple of variants. There's average revenue and there's marginal revenue. And we need to deal with average revenue and marginal revenue because they're going to play a role in chapters 9, 10, and 11 in the market structure chapters. Average revenue, the first one. Average revenue tells us, on average, how the total revenue is influenced by each unit of output currently produced. Average revenue is defined as total revenue divided by quantity. Let me give you an illustration. Let's say, for example, a business has revenues of $1,000. Okay, so it has total revenue of $1,000. And let's say it earned that $1,000 in revenue by having produced 100 units of output. So total revenue is $1,000. The output is 100 units. So we take the $1,000 and divide it by the 100 units of output. We get average revenue equals 10. And that $10 is telling us how much revenue each of those units added to the overall revenue. So each of the 100 units is contributing on average $10 in revenue to the total. Okay. Now, so since average revenue, since total revenue is price times quantity, we can then glean from that average revenue is always equal to price. So if I define average revenue as total revenue divided by quantity, and I know that total revenue is price times quantity, then that means by definition average revenue is going to equal price. So to say average revenue and price are synonyms. They're one and the same. So average revenue is the same as price. Okay. The next revenue concept is called marginal revenue. Again, this is another of these marginal concepts that we've been dealing with. And marginal revenue tells us how the next unit produced will impact total revenue. So again, marginal concepts always tell us the impact of individual something. Like we introduced marginal product. It told us how the next unit produced would affect output. We talked about marginal cost, how the next unit produced, how would it affect total cost. Marginal revenue tells us if a business produces the next unit, how will that next unit produce, how will it affect the business's total revenue? How will the total revenue change as a result of having produced the next unit? Alright, so marginal revenue is going to give us the impact of the next unit produced on revenue. So if a business produces say one more unit, and that unit causes revenue to go up by, I don't know, $50, then that's the contribution of that next unit to revenue. Alright, kind of a unique feature about pure competition is in pure competition we have the price of the product is equal to marginal revenue is equal to average revenue. So under conditions of pure competition, price equals marginal revenue equals average revenue. Price by definition is the same as average revenue. And the reason why price equals marginal revenue, as we will see, is when a firm has no market power, as is true of the firms in this industry. The price it's going to charge will by definition equal marginal revenue. So whenever price equals marginal revenue, that's a sign that the firm in question has no market power. And that will become clear as we go further in the chapter. Alright, so let's now, so we have that preliminary issue out of the way. Another preliminary issue we have to look at is how do we determine how much the firm should produce? How do we determine the optimal amount of production? These firms are trying to maximize profits or minimize losses, and so we got to have some way of determining how much they should produce. And the way we do that is we adhere to a rule called the marginal revenue equal marginal cost rule, also known as the profit max rule or the loss minimization rule. And so a firm should produce output up to the point where its marginal revenue equals its marginal cost. And where marginal revenue equals marginal cost, the firm will either experience the largest profit or the smallest loss. So these firms, when they start producing output, they're going to try and they will produce at the point where their marginal revenue equals their marginal cost. Okay, and at the beginning of the chapters, the rationale for that is discussed in terms of why you want to focus on producing where marginal revenue equals marginal cost. But we're going to adhere to this rule to define the optimal level of production. We will look to see where the firm's marginal revenue equals its marginal cost. Okay, so once we have the revenue issues under control, that is, price equals marginal revenue equals average revenue. And once we know how to find the optimal output for the firm, where marginal revenue equals marginal cost, then we can start building both a numerical model and a graphical model for a firm. Again, our focus is, it's like we're taking of the thousands of firms that are competing, we're taking one of the firms out of that fray and just kind of studying its behavior. Right? So we're going to try and model the behavior of a purely competitive firm. Okay? All right. And so to do that, to build the model, when you build a model, we have to know how to systematically analyze it. Okay? And I've given you a series of steps to help you analyze the model for a firm. And these steps will apply to each of the economic scenarios except for the so-called shutdown case. So the 4 steps that I'm about to describe do not apply to the shutdown case, as I will describe. The first thing you do when you have the model, and we'll develop the model, and so this will be clear, is you want to locate Q star. And as we just said, the way we determine Q star is you find where marginal revenue equals marginal cost. So whether you're looking at numbers or whether you're looking at the graphical model, the first thing you want to locate is where does the marginal revenue value equal the marginal cost, because that gives you the location of how much the firm should produce. Right? And once you find Q star, then everything is linked to Q star. Everything is anchored at Q star. So, for example, once I know Q star, I can determine the revenue. Remember, the price the firm is charging is taken from the market, so the price is a given. So the firm will be given a price, and you take that price and you multiply it times Q star, and that gives us the revenue the firm will make. In step 3, we want to determine the total cost that the firm is incurring as a result of producing Q star. Again, everything is anchored to Q star. And the way you can calculate the total cost is you would take the average total cost and multiply it times the quantity, times Q star. And the average total cost will be the average total cost that corresponds to Q star. So there will be some average total cost values that are irrelevant, and we're trying to find that unique average total cost value that corresponds to Q star. And once we do that, we multiply those two together, average total cost and Q star, and we get total cost. Okay. All right. So the first 3 steps are kind of like just navigating through the model. And notice in step 2 we're calculating total revenue. In step 3 we're calculating total cost. So the first 3 steps are really an accounting exercise, because there's no reference here in the first 3 steps to total economic costs. But in step 4 we have to draw a conclusion based on the relevant economic scenario. So our conclusion will be not accounting profit but economic profit, not accounting loss but economic loss, not accounting break even but economic break even. And there is a way to do that. In order to do so, in order to determine the relevant economic scenario, we need to impose an assumption. And this assumption is really just to give some simplification to what we're doing and help us to avoid a lot of unnecessary complexity. Here's the assumption. If we go through steps 1, 2, and 3, and say we find that the firm's revenue is greater than its cost, under those conditions, we're going to conclude accounting profit. Now, for me to assert the firm is making an economic profit, what has to be true is the accounting profit that the firm earned has to be greater than the accounting profit the firm would make doing anything else. That would make the firm's choice the best choice. Okay, so this is what I'm going to do. Whenever we go through the first 3 steps and we get an accounting result, I'm going to impose an assumption to make the results economic. So if we get an accounting profit result, I'm going to say, okay, the firm is making economic profit because this accounting profit is larger than any other profit it would make doing something else. Or if the firm experienced accounting loss, I'm going to transform that into economic loss by saying the accounting loss it's incurring is larger than the accounting loss it would incur doing something else. And that makes its choice the worst choice, which would mean it makes economic loss. Okay, so I need to do that so that we can, in step 4, draw economic conclusions, not just accounting conclusions. And if you have questions on this part, which is usually kind of tricky for people, please send me an email and I can hopefully give you a little more insight. Alright, so now we're ready to look at the how to construct a model for a purely competitive firm, and we'll do that by referring to another exhibit that I have created for us, and that exhibit is going to be right here. Let's introduce it. All right, so let's look at how to develop a model for a firm, both numerically and also graphically. Okay, and in the textbook there are other cases depicted, so I'm going to depict one case and hopefully you can see from the way it's developed how to work through the other cases. And of course, if not, please send me an email and I'd be happy to try and walk you through it or describe it for you. Alright, so let's say in this particular case that we have this purely competitive firm and the price it's charging is $550. So the market price is $550. And so this firm takes that price and just runs with it because the firm has no market power. It can't change the price. So for every unit it produces, and the units here in terms of tons, every ton of output it produces, it charges a price of $550 for each ton. Alright, and so I take the quantity column times the price column and it gives me the total revenue column. So price times quantity gives me the revenue the firm makes as it produces different amounts of tonnage of some product. Alright, notice that the marginal revenue column is $550, which is the same as the price. So as we stated earlier, in the conditions of pure competition, price and marginal revenue are the same. And you calculate the marginal revenue by simply taking the difference between the total revenue values. For example, if you take 550 minus 0, the difference is 550. If you take 1100 minus 550, the difference is 550. So the marginal revenue will be the same as the price because this firm has no market power. Now I have some sample cost here. I'm assuming that the total cost of producing the output is reflected in this total cost column. I calculate the marginal cost by looking at how the total cost changed. Like for example, if I take 1200 minus 1000, it gives me marginal cost of 200. If I take 1350 minus 1200, it gives me marginal cost of 150. So I calculate the marginal cost values that way. The average variable cost and the average total cost information is just given. I'm assuming those are the average variable cost and average total cost numbers for purposes of demonstration. And then I can calculate in the last column the amount of the accounting profit or loss. And the profit is simply where you take the total revenue, take the total revenue column, minus the total cost. So for example, on the last entry of $600, you take the total revenue, which is $4,400, minus the total cost of $3,800, and that gives you profit in this case of $600. Okay, so whenever the revenue is greater than the cost, you get profit. Whenever the cost is greater than the revenue, as you see in the first three entries here, the firm incurs an accounting loss. Alright, so how much did this firm produce? Well, we want to find its Q star, and Q star in this case happens to be 8 tons. So that it will be in this firm's best economic interest to produce 8 tons. And the reason why we settle on 8 is because, as you see, the marginal revenue is $550 at 8 tons, and the marginal cost is $550. So the firm produces where its marginal revenue equals its marginal cost. Now it turns out here that at 7 tons the profit would also be $600, but that is a kind of an anomaly given that we're dealing with discrete data. But so what we're gonna do is we're gonna focus on using the marginal revenue equal marginal cost rule to locate the optimal level of production. So this firm is going to produce Q star units. Alright, Q star units being 8 tons. Alright, now notice also here that the price it's charging of $550 is greater than the relevant average total cost. So the relevant average total cost is the $475. So at 8 tons, the relevant average total cost is $475, and so you compare the price it's charging to that relevant average total cost. And when the price is greater than the average total cost that's relevant, the firm is making a profit. Okay, so that's a quick way of determining profit. At Q star, does the price charge exceed the average total cost? If the answer is yes, that means the firm is making a profit. Okay. Now, when I draw the conclusions from this numerical model, I have calculated the revenue. I took the price, which was $550, times Q star, which in this case was the 8 tons, and it gave me the revenue of $4,400. I calculate the firm's total cost by taking the Q star, which is 8 tons, and multiplying it times the relevant average total cost, which was $475, and that gave me total cost of $3,800. And then I take the total revenue minus the total cost, and that gives me, in this case, an accounting profit of $600. It's accounting because we're looking at what the firm did. We're looking at only at the firm's choice. For it to be economic, we have to look not only at the choice it made, but also the choice it didn't make. Because remember, economic profit says the choice you made was the best choice. So for me to conclude economic profit, which I'm going to do in this case, I'm simply going to assume that this profit that it earned of $600 is the largest profit it would have made, irrespective of what it could have done. So by participating in this industry, this market, and making this profit, any profit it would have made anywhere else doing something else would have been smaller. So its choice of being here was the best choice. So I'm going to assign to that a meaning of economic profit, even though my model is strictly focusing on what the firm actually did. Okay? Again, that's kind of tricky. If you have questions on that, please direct them my way. Now, what I need to do also is to be able to look at this behavior of the firm graphically. I want to be able to see how to find Q star graphically. I want to be able to see that the price is greater than when the price is greater than the average total cost, the firm is making a profit. So in order to do that, if I were to take the price column and graph the price with respect to the quantity, price is constant, so the price column would graph as a horizontal line. Now it turns out this price quantity comparison is really like the demand curve faced by the firm. So if I graph the price with respect to the quantity, I'm going to get a horizontal line, and that's going to represent the demand curve that the firm faces. Now, when the demand curve is horizontal, as you learned in the chapter on elasticity, it means that the demand in question is perfectly elastic. And of course, perfectly elastic customers are ultra price sensitive, and what makes them so price sensitive is that they have many choices. And it makes sense here because the firm we're studying is one of thousands of firms that could be serving the customers. So the customers have many choices, and so accordingly, the demand faced by a purely competitive firm is going to be perfectly elastic. Okay. All right. I also would need to graph the marginal cost data. I also need to graph the average variable cost and the average total cost. So those four series: price, marginal cost, average variable cost, average total cost, they have to be plotted with respect to the quantity to see the graphical depiction of this model. And I've done that down below. And when you plot those four series, you get this resulting purely competitive firm model. The horizontal blue line there, which is reflecting the price, the behavior price, it is horizontal at $550, and that horizontal line is the firm's perfectly elastic demand curve. The marginal cost, which is the reddish line, is exhibiting that Nike swoosh behavior that we talked about in cost theory, and I also plotted the average total cost and the average variable cost. Now the important thing to note here is our Q star, as we saw, was 8 units, so 8 tons. And so if I go directly above Q star, I see that the marginal cost and the price are intersecting at that point. So at that point, price, which is the same as marginal revenue, equals marginal cost. And so the firm should produce at that point. And so by producing where price or marginal revenue equals marginal cost, as we saw, it will make the highest profit in this case, or if it were a loss case, it would make the smallest loss. Okay. All right, so that's the short run model. the difference between, the reason why I know it's short run is there's a difference between the average total cost curve and the average variable cost curve, and that difference is average fixed, and fixed costs only exist in the short run. Okay, so let's go back to the PowerPoint presentation. We've introduced the short run model, and the scenario I looked at was the profit case. The model would be slightly different in terms of the relationship between price and average total cost to depict the other cases. And some of the characteristics of the other cases that we would see. If we looked at a case of profit where we saw the price of $5.50 in our example was greater than the average total cost of $4.75. We also saw that the Q star was positive. The firm would produce 8 tons. And based on my assumption about the opportunity cost, we concluded that total revenue would be greater than total economic cost, which would make it an economic profit scenario. And we found Q star, of course, where marginal revenue equals marginal cost. If the case had been a loss case, what would have been true is that price would have been less than average total cost at Q star. Q star would still be positive. Our total economic cost would have to exceed the total revenue to create an economic loss. And of course, to find Q star is where marginal revenue equals marginal cost. If we had the break-even case, then price would equal average total cost. Q star would still be positive, and total revenues would equal total economic costs. So in the break-even case, how the firm fared would be the same would experienced had it produced in a different industry. Right? And marginal revenue, of course, would equal marginal cost, because that's how we find Q star. The unique case, the kind of the anomaly, is the shutdown case. And the shutdown case is where the resulting market price is so low that it is below all of the average variable cost values. So when you're looking at the average variable cost, when the price that's being charged is everywhere less than every average variable cost value, the best thing for the firm to do is to shut down, because its losses would just be so large. So under conditions of shutdown, the Q star actually is going to be 0. The firm will produce nothing. So its Q star will be 0. And by producing nothing under conditions of shutdown, the firm will limit its losses to just its fixed costs. So if it produces nothing, it has no revenue, and its cost will consist of only fixed costs, because at no production, variable costs would be 0. And so I would encourage you to look at the cases in the textbook, because each case is identified, so that you can distinguish economic profit, economic loss, break even, and shutdown. And look for these characteristics. It will make it easier to distinguish one case from another. Alright, so those are the short run possibilities. The next thing we do, now that we have looked at the preliminary issues, now that we looked at the economic scenarios in the short run, we can then proceed to the adjustment phase. And in the adjustment phase, in pure competition, the entry-exit activities are dynamic. The reasoning being, there is the assumption that there are no barriers to entry. So firms can come into this industry, firms can exit the industry. There are no restrictions on them doing so. Now, so let's say we come out. The case we looked at was economic profit in the short run. Okay? So we observed this case. If there's an economic profit, that means that being in this industry is better than being somewhere else. And so firms that are outside of the industry will want to come into this industry, because coming into this industry would be better than where they currently are. And so when those new firms start to enter this market, they're going to cause an increase in supply. There are more sellers, so supply will increase. And when supply increases in the market, the price falls. So this is kind of like chapter 3 stuff. We talked about like supply induced cases. If there are more sellers, it causes supply to increase and the price in the market would fall. So in this case, we start out with a price greater than average total cost. That's the economic profit signal that's being sent out. And when competitors start flooding in, the price ends up being forced down to equal average total cost. So these new firms keep coming in. As long as the price is greater than average total cost, being in this industry would be the best choice. And so firms keep coming in. As they come in, they push down the price until it equals average total cost. And once the price is forced to equal average total cost, there is no incentive then for new firms to come in, because how they're doing where they're at is equivalent to what's occurring now in this industry, profit-wise or loss-wise. And so there's no incentive for firms to come in. And so the adjustments stop at that point. Now, had we looked at the loss case, everything would run in reverse. When losses or economic losses are being made, that means that being in this industry is not the best choice. You'd be better off, the firms would be better off somewhere else. And so what happens is some of the firms start to leave. And as they leave, that's going to cause supply curve to shift to the left, because there are going to be fewer sellers, so there'll be a decrease in supply. And so when they have a decrease in supply, it pushes up the equilibrium price, and so the price starts to rise in the market. Remember, they're starting with price less than average total cost, and so the price rises until it equals average total cost. And once it equals average total cost, firms stop leaving and the industry stops adjusting. Okay, so if you have economic profit, competitive pressure will force the firms to experience economic break-even. If you have economic loss, competitive pressure will recalibrate the market and result in economic break-even. Now, third scenario is, what happens if we had economic break-even in the short run? Well, if you have economic break-even, what that means is that being in this industry is no better or worse than being somewhere else. And so what that means is no firms will want to come in, because they wouldn't be any better off. And none of the existing firms would want to leave, because they wouldn't have anything to gain. So when you have break even, you have neither entry nor exit of firms, because the price is already forced to equal average total cost. The last scenario, which is this kind of odd scenario, the anomaly scenario, is called the shutdown case. If we have we had identified a shutdown case in the short run, where the price is being charged is everywhere less than the average variable cost values. What would happen in that case, the best thing for the firms to do would be to stop production. Q star would be 0, right? No production would take place, because under conditions of shutdown, the losses are just too large. And so if there's no production occurring in the market, then the industry would basically collapse. All right, so in the shutdown case, it results in a complete collapse of the market, because the price is just too low. All right, so that's the adjustment activity. Now, to kind of recap what we've done, and I acknowledge we're covering a lot of territory, but feel free to review over this lecture as much as you like, and hopefully you'll get a sense of the rhythm that's kind of built into this presentation. So coming out of the short run, we looked at the 4 possibilities. We looked at the case of economic profit, economic loss, break even, and shutdown. And then coming out of the short run, if you have economic profit, as we just saw, it's going to cause the entry of firms, and that's going to lead eventually to price equaling average total cost. If economic loss had occurred, that would result in the adjustment phase of firms leaving, and price would eventually equal average total cost. If we had break even from the short run phase, that would result in neither entry nor exit, because price is already equal to average total cost. So in terms of the adjustment phase, there are 3 things that are common: is that economic profit, economic loss, and economic break even all result in the same outcome, and that is economic break even after the adjustments occur. The only exception would be the shutdown case, and that's where the industry would just be lights out in the industry, and so there'd be nothing happening going forward. So coming out of the adjustment phase, those results then flow into the long run, and the only relevant ones that we can take forward is price equaling average total cost. So in the long run phase, after the adjustments have occurred, price is forced to equal long run average total cost. is simply reflecting the beauty, if you will, of competition. Competition prevents profits from being too large, and prevents losses from being too small. It kind of levels the playing field. All right. So with that in mind, we can then start to transition to the long run phase and try and tie this industry together. All right. So we want to study the long run model at this point, and so we'll go back to our previous exhibit and look at another section of it. Okay, so in this part I'm looking at the long run purely competitive model, and of course in the long run there are no fixed costs. So there are no fixed costs to be identifiable in this particular model, and in the long run, as we just saw, the price charged would be forced to equal long run average total cost. And so to create that, I'm going to say that because we had a profit case and it caused firms to enter the market, that the price fell from $550, as we saw in the short run, to now the price has been pushed down to $465. Okay, so with the price of $465, we can calculate the revenue by simply taking price times quantity, which I did in the revenue column. Notice that the marginal revenue is equal to the price, only true in pure competition. Price equals marginal revenue. Total cost, same cost I had before. I recalculated the marginal cost because there were no fixed costs to contend with, and so the marginal cost I calculated here. And notice in this case that the marginal cost now that's relevant is $465. I also have calculated the average variable cost and the average total cost. They're one and the same because there's no fixed cost of any type in the long run. And then I went through and recalculated the profit and the loss. And it turns out in this scenario, based on my hypothetical data, it turns out that the firm would experience accounting break even at 7 units of output, because when Q star is 7, the marginal revenue equals the marginal cost, and the resulting outcome is the best of all the scenarios, 0. Everything else is negative, and so the firm is literally making accounting break even. And so taking these numbers and assessing, I take the Q star of 7 units, multiply it times the price, which is $465, and that gives me revenue of $32.55. I calculate the long run total cost by taking Q star, which is 7, times the relevant long run average total cost, which in this case is $465. Take 7 times $465, and I get $32.55 again. The difference between the two is 0. So in my model, I'm assuming the firm experiences accounting break even, and that's just to help me conclude economic break even, which means that for the firm to have experienced economic break even, that the accounting break even is realizing here in this industry, that is the 0 outcome. It would also realize that had it participated in somewhere else. So it's making accounting break even here. If it made accounting break even somewhere else, that means that the outcomes would have been identical, and it would have also realized economic break even. So I'm imposing that assumption just so that I can be consistent when I talk about break even. I can transition from accounting break even to economic break even evenly. Alright, so if you take the data, you take the price data, you take the marginal cost data, and you take the average variable cost, average total cost data, which is the same. Those two curves are now the same, and you plot that, you get the model for a firm in the long run. Okay. Again, now the firm's Q star is 7 tons, and notice here at 7 tons, the price, which is the blue line, equals the long run marginal cost, and it also equals long run average total cost. So the price is equal to long run average total cost, which suggests economic break even. So all three curves converge and they coincide at our definition of Q star, which is 7 tons. Okay. All right. So that's the long run model. Now, so now we can tie things together based on that result. Before we do so, we want to look at some efficiency tests. So after the smoke is cleared, after going through the turbulent short run phase, after going through the adjustment phase, now things have settled, and we just want to kind of assess how things have fared in this industry. And there are 2 tests that we apply to try and detect efficiency. One is called the allocative efficiency test. It's kind of like a resource test. We're testing to see if resources are wasted. And the other one is called the productive efficiency test. And it's a test to see if costs have been minimized due to the intense competition. The criterion for the allocative efficiency test is you go to Q star and you compare the price that's charged to long run marginal cost. If they are equal, that implies that no resources have been wasted. The reasoning for that: price is associated with the demand curve, long run marginal cost, as you read about in terms of identifying the supply curve for the firm. It's like saying demand equals supply at that point. And when demand equals supply, of course, that's an equilibrium outcome, and there's no waste of resource in equilibrium. So saying price equals long run marginal cost in pure competition is like saying the demand for the firm's product equals the supply of the product, and there is no waste. So the firm satisfies this test because, as we saw in the previous exhibit, the price it's charging coincides with long run marginal cost at Q star. Now, the productive efficiency test, we're testing here to see if the firm is producing the output at the lowest cost on average. That is, and it stands to reason that that's going to be the case because this firm is facing intense competitive pressure. And the competitive pressure is forcing the firm to be lean and mean. So the firm is always trying to find a way to reduce costs. And so the criterion for evaluating productive efficiency is at Q star, does the price charged equal the minimum long run average total cost? Does it coincide with the lowest point on the average total cost curve? And so under conditions of pure competition, the answer is yes. Competitive pressure forces the cost that the firm incurs down to the lowest level. Because in order to remain competitive, the firm has to not be inefficient when it comes to cost. So the price it's charging does in fact equal minimum long run average total cost, and so as a result we say the firm is productively efficient. Now both of these tests in this case have been satisfied. A purely competitive firm is allocatively efficient and productively efficient. It is only in this industry, only in this market, where both tests will be satisfied. Competition, intense competition, promotes efficient use of resources, and these tests are confirming that. All right. Now, to kind of tie the long run phase together in terms of pure competition, as we saw, competitive pressure forced the firm to experience economic break-even. If the firm experienced a profit in the short run, competitors would come in and eat away at the profits. If the firm was making a loss, competitors would leave and would end up in break-even mode. We just saw the firm is allocatively efficient because at Q star price equals long run marginal cost. We also saw that the firm is productively efficient because the price it's charging does in fact coincide to the lowest point on the average total cost curve. So we can conclude, due to the intense competitive pressure in this market, thousands of firms competing, the firms will make neither excessive profits nor losses. Competitive pressure will basically level the playing field. And the competitive pressure will also force the firms to use resources wisely and produce output at the lowest cost. This is why we love competition in economics. It results in efficient use of resources. It results in lower prices for consumers. It also results in diverse products being available in various competitive markets. All right. So that concludes a rather busy trek through the world of pure competition. Again, I'm assuming you would have questions, and I am available to answer those questions. Please ask them. Please send them to me in terms of message. But spend some time with the lecture here. Go over it as many times as you like, and hopefully you can pick up on that flow that's built into the lecture, and it will give more meaning to your reading, and hopefully help you to see the significance of pure competition. Pure competition is our standard. We want industries to have a lot of purely competitive characteristics, because as we just saw in the conclusions, pure competition results in efficiency, low prices for consumers, and those are great things. So until next week, study hard and take care.